Okay. So before coming to this class, I seriously doubted how much should I spend today. So if you are just coming for 30 minutes or 20 minutes, it is your waste your time. And then if I use all 75 minutes for this class, then you will be bored. So the decision that I have is that I'm going to have 1 hour and then I will finish this class. Okay, so let me move on to chapter 1, interpreting financial statements. So in this chapter, we are going to review what we know about the financial statements. I guess that you already know 3 basic financial statements, but let me just rephrase it for our purpose. So for today, I'm going to talk about those financial statements, and then next week I can talk about the problems when you interpret financial statements. Okay. Financial statements are written records or documents that convey a firm's business activities and financial performance. By a firm's business activities, it means everything a firm does for making money. For example, purchasing the inventories, selling it to your customers, and manufacturing something from your factories. Everything are called operating activities or business activities. And the result, the conclusive money that you collected or you earned are called financial performance. And there are 3 major financial statements that we usually refer to. The first one is balance sheet, second one is income statement, and the third one is cash flow statement. So I'm just going to start with the balance sheet. Balance sheet. A balance sheet is a financial statement, is one of the financial statements that report a firm's assets, liabilities, and equity at a specific point of time. So it is different from income statements in a sense that it does not reflect a period of time. It is similar to taking a picture just for a second and then take a look at the picture. And what we want to know from the balance sheet is the assets, liabilities, and equity. So what are the assets? Assets are resources. In other words, capital that can be used to produce a valuable thing for the future. That can produce a future economic value. So if something can give you some benefits for your future, then you can call it asset. For example, if I have a car and if I use it to ride to school, then I have a benefit that I can save my time. So car is my asset. Okay? Similarly, if a firm has something that can benefit the firm, then you can call it asset. The second thing is liability. So liabilities are the claims to assets. However, it is the claims by others than shareholders. So someone who is not the shareholder, if they have some rights to take something from your company, then it is called liabilities. And finally, we have equity, in shortened word, or shareholders' equity, precisely, which is the claim to assets but by the shareholders themselves. So by definition, if you have assets, then take out the liabilities, and then the left things over is the shareholders' equity. So we can write it in a very simple equation, what we call fundamental accounting equation. So fundamental accounting equation states that the asset is always the same as the sum of liabilities plus shareholders' equity. However, actually, there is a very small minor error in this term, fundamental accounting equation. So, because I have a scientific background, I'm sometimes very sensitive to this. So, by equation, it means that equation can make it true for some values, but sometimes it is false for other values. In that case, we call it equation. However, this is not true for this relationship, so it is better to call it as identity, which is always true. Okay, so that's the minor opinion I have. Do not tell it to accounting professors. Okay, I'm different from them. Okay. Anyway, coming back again. One interesting thing about the fundamental accounting equation is that it applies to the firm as a whole. However, at the same time, it also applies to particular transaction. So for every transaction, this relationship holds. And I'm going to show you this throughout several examples. So consider a newly founded firm, and let's think about a small merchandising firm. So you buy something from a wholesale market and then you sell it to customers, okay? And then you, as a founder, you invested your cash, which amounts to $1,000. And then you can make a balance sheet for your company. And this will be look like this. So you have assets, but the only asset you have is right now is cash. So you have $1,000. So total assets equal $1,000. But on the other side, you don't have liabilities because you founded this firm by yourself. You did not ask for help from others. So you don't have liabilities right now, so no liabilities, but you have $1,000 shareholders' equity because you put your money to the firm. And here again, the total assets equal total liabilities plus shareholders' equity. So the accounting equation holds for this company. And then one interesting thing is that this founding a firm transaction, still you can find that the equation holds. So there was zero asset before you create this firm. So actually assets increase by 1,000, and then equity increases at the same time by 1,000. So the increase or decrease are the same. Okay, so that's the interesting thing about the accounting equation. And then let's develop this situation further. So suppose that the firm now, you as an owner, you decide to purchase some merchandise for $800. And then you did not pay it in cash full. You paid $6,000 in cash, but you said that, hey, I'm going to pay you later $2,000 left. So you are owing $200 to the supplier. And then by this transaction, your balance sheet will change. And let's take a look. First, you spent your cash $600 from $1,000. So now you have $400 cash. And at the same time, you purchased merchandise. So it is now in your inventory. So we call it inventories. And you have inventories worth $800. And then your total assets become 400 plus 800, which is 1,200. Then what happened to the other side? On the right side, you have liabilities right now. Because you are owing $200, the suppliers can take $200 when the due comes. So we call it accounts payable. So you have $200 account payable, which is the only liability you have right now. But there's no change in the fact that you put $1,000 at the beginning. So the shareholders' equity is still $1,000. So as a result, the liabilities and shareholders' equity, by summing these two, you get total liabilities and shareholders' equity as 1,200. And surprisingly, this equals total assets again. So we can see that for the firm, in aggregate, the equation holds. And at the same time, let's take a look for this specific transaction. So what happened? Cash decreases by 600 by this transaction, but at the same time, inventories increase by 800. So summing these two, they canceled out each other, and the only increase on asset has is 200. And if you look at the other side, liabilities has increased by 200 from the accounts payable item, but no change in equity. So by summing these two changes, you again get 200, which is the same for the assets. So again, for this transaction, the equation holds. And finally, let's sell these merchandise and make some profits. So suppose further that now you sell these merchandise for $900. So because you are buying from the wholesale market and selling it to the retail market, now you can sell it at a much higher price. So you succeeded in selling it $900. And of course, it would have been better if you can receive all in cash. However, your customer said, hey, I will buy your merchandise forever, so at this moment, let me just pay $800 in cash and let me give you another $100 later. So it happened right now, and then you agreed it. So now what happens to your firm? So cash becomes 1,200. So before this transaction, you had 400 cash, but now you received $800 in cash, so the cash becomes 1 and 2. And then now you have a right to receive something in the future. By definition, this is an asset because you can take some benefit in the future. So this $100 to be paid, we call it account receivable, and now it is on an item as an asset. So you have $100 accounts receivable. However, you spend out all of your inventories, you sold it, so there's no inventory left. So in aggregate, total assets amount to 1,300. But on the other side, let's see what happens. There's no change in the fact that you still need to pay $200 for your supplier. So the liabilities you have is only $200. And then, according to the accounting equation, you need to have the same amount as the total asset for total liabilities and equity. So it should be 1,300. That means your shareholders' equity should be not 1,000, but 1,100. So this is the change right now you have. And then, for this transaction, you gained cash by 800, and accounting receivable has increased by 100, and inventory decreases by 800. So if you sum these all, you get a conclusion that your assets increased by 100. And then this is the same for the liabilities and equity side. So there, even though there is no change in liabilities, but because you have equity increased by 100, now the accounting principle holds for this transaction again. So from these examples, we can understand that the accounting equation always hold. Okay? And the next financial statement is income statement, which is a financial statement that reports a firm's revenues, expenses, and incomes over a specific period. So balance sheet was taking a snapshot, but contrary to it, income statement is taking a video. So you start the video and you wait so that you can see what are the changes. And there are three things that you need to know from income statements, which are revenues, expenses, and incomes. But I have different definitions for them. I usually define revenues as either increases in assets or decrease in liabilities. But the common idea is that if you receive something, then they are revenues. And expenses are something you spend for your business activities, but I'd like to define it as decreases in assets or increases in liabilities. And finally, I'd like to define income as increases in equity. And at the same time, loss will be the reversed version of the income, so losses will be the decreases in equity. So you might be confused because I'm trying different definitions from your common knowledge, but you will realize that those two are the same. Okay, so let me reconsider the previous form. So for these three transactions, you can summarize it in an income statement simply like this. So you have sales. So you sold merchandise to your customers at $900. So you have generated sales of $900. And you purchased merchandise at $800 to have them in your inventories. So merchandise purchase are expenses and they are $800. And after you sum all the revenues and deduct all the expenses, you get income, what we call net income, which is $100 for this firm. But let's think about my definition. So why sales are increasing in assets or decreasing liabilities? Because these sales transactions was conducted by increase in cash of $800 and increase in accounts receivable of $100. So cash increase, this is an increase in asset. Accounts receivable increase, this is an increase in assets. So my definition is true for this case. And for this second item, merchandise purchases, why is it expense? Because it is composed of decrease in cash of $600 and increase in accounts payable, which is increase in liabilities. So again, my definition is true for this case. And finally, the net income has result in my shareholders' equity changed to 1,100 from 1,000. So there was an increase in equity of $100. So my definition about the income is true for this firm. Okay, so that's why I'd like to define revenues, expenses, and incomes or losses as the previous definitions. Okay, so far we have taken a look into two major statements, which are balance sheets and income statements. And from the example that I used, you can realize that running a business involves a lot of changes in your cash. So you need to purchase some merchandise to have inventories, and you need to spend cash, and then you generate some cash by selling it to your customers. Okay, so whatever you do, you often get a change in cash. So cash is very important, so that we want to know about cash specifically. And furthermore, it is very important to check the amount of cash you have, because if you do not have enough cash, then you cannot continue those transactions. You cannot purchase any more from your suppliers. So maybe your supplier will come to you and say, hey, give me the money. And then you need to say that I'm bankrupt. So you cannot, your business will be discontinued if you do not try to maintain the cash amount. So this importance of cash is summarized in this figure. So cash is used for every transactions, every activities you have. Of course, sometimes you don't have to touch cash. You can pay in accounts receivable, or you can have accounts payable on other securities as well. But in most cases, you need to use your cash. So if you want to manufacture your products, you need to first have facilities and your factory for the manufacturing. So you need to spend. And that transaction, we call it investment in a narrow term. And then if you produce some products or services, and then if you sell them to your customers, then you get the cash. So the cash are returned to you. So there is a circle. There's a cycle that are involved with your business activities, and there is an increase and decrease in cash. So these increases and decreases of cash, we call it cash flow. Cash flow is the change in cash amount or cash equivalents. Specifically, we call cash inflow if you have an increase in cash, and we call it cash outflow if you have a decrease in cash. And then the problem of the previously described two financial statements is that it does not show you enough information about the cash you have. So sometimes accounting profits do not match your cash flows. In our previous example, you earned from an accountant perspective, you earned $100 by selling the merchandise, but your cash flow was $200 because you started with 1,000 cash, but you end up with 1,200 cash. So the change in cash was $200. So sometimes it could be different from each other. So we need the third financial statement that particularly concentrate on the movement of the cash, and they are cash flow statements. So cash flow statement is a financial statement that summarizes cash inflows and outflows over a specific period, similarly to the income statement. However, while income statement describes your accounting profit, the cash flow statement describes the change in the cash only. And particularly because we are summarizing our activities, we do not describe every cash move. So we do not say, today we have $200 cash increase minus $100 in cash, so blah, 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 blah. But we summarize it for our readers. So we have 3 categories for activities. They are operating activities and investing activities, and finally financing activities. First, operating activities are the activities you do in the production and selling process of your services and your products. So this is the core activities you need to do for your business. And then the second activities are investing activities, but here the term investing here, it has a narrower meaning that we purchase some long-term assets. For example, factories, facilities, PPEs, those are the investing activities. So if we purchase or sell some of our long-term assets, then we call them as investing activities. And finally, because now in the investing activity, you are talking about the change in asset, now you have 2 left, equity and liabilities. So the financing activities refer to the business activities that are related to the changes in liabilities and equity. So by having these 3 categories, you can successfully summarize your activities fully, and then you can show the readers what happened to your cash. So let me use the firm again, and let me write the cash flow statement for the firm. So this is the cash flow statement for the firm that you found. So there are 3 categories: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Thankfully, it was a very simple example so that we do not have investing activities nor financing activities. But we only had operating activities of purchasing and selling merchandise. So we start from the net income. So this is known to be the change in our cash if we have done our transactions all in cash. However, there are certain differences between net income and our actual cash changes because we have used accounts receivables or accounts payable. So we want to reflect them in here. So we start from net income. However, we received not cash, but we received accounts receivable. So actually, we were not able to get enough cash. So there is a minus 100. And then we didn't pay in cash, but we were able to pay in accounts payable instead. So by doing so, we were able to save our cash. So we have a positive $200. So if you reflect these 2, then we get a conclusion that the net cash provided by the operating activities is $200. And because we have no investing activities and no financing activities, in aggregate, the net change in cash should be 200 plus 0, which is 200. And then, because we started our business with $1,000 cash, and we get $200 net, so our cash at the end, in the end, should be 1,200, and we confirm that this is true from our balance sheet.